Welcome back to Boss Economics World, where we scrutinize today's global financial challenges, often resulting from shambolic government policies or insufficient regulatory enforcement. Today, we're diving into a topical issue that makes headlines both in financial markets and geopolitical discussions. DBS Group Holdings, Singapore's largest lender, is expanding its wealth management team to cater more to wealthy Russian clients. This decision makes DBS stand out, especially when global financial players like UBS, HSBC, and others are scaling back their operations with Russian clientele due to the escalating sanctions risks emanating from Russia's war in Ukraine. At first glance, this is yet another decision based on broader strategies in the global financial markets. But looking deeper, it reflects some seismic shifts in the global economic and financial landscape, shifts that ultimately reveal the competitive dynamics of global wealth management, regulatory arbitrage practices, and the challenges posed by sanctions regimes. Stay with me as we unpack this complex issue through several economic lenses, from non-uniform sanction compliance, risk versus opportunity dynamics, to the shifting centers of offshore wealth management. As many global banks scale back their Russian operations, DBS appears to be running counter to this trend. Not only are they expanding their clientele from Russia, but they have also fortified their team of Russian-speaking private bankers, aiming to serve affluent Russian individuals seeking to park or move their assets amid growing sanctions from the US, EU, and other Western powers. The real irony here is that while most global financial institutions are tightening their belts and scrutinizing every account linked with Russia, DBS seems to have found opportunity in crisis. The fundamental question begging for analysis is this: what economic factors drive this bold contrarian strategy, and what risks does it carry? The global private banking sector has always been defined by delicate balancing acts. On one side, banks want to preserve their reputations and avoid regulatory penalties by adhering to stringent anti-money laundering (AML) standards and enforcing international sanctions. On the other, they seek to capture the booming wealth of high-net-worth individuals, HNWIs, who are always on the lookout for jurisdictions that offer financial stability, confidentiality, and legal security. In light of this, let us understand why Singapore, and by extension, DBS, appears to have become a magnet for Russian capital. As long-established financial centers like Zurich, London, and New York have started closing doors on Russian wealth due to the pressure and complexity of Western sanctions, Singapore has emerged as one of the remaining bastions for certain Russian wealth. By maintaining a comparatively neutral stance, while still imposing some unilateral sanctions against Russia, Singapore effectively balances between two regulatory worlds. It remains firmly within the global system of anti-money laundering protocols but cleverly avoids becoming overly entangled in the hostile geopolitics that is driving much of the sanctions. For decades, Singapore has carefully nurtured its reputation as a stable, trust-centric financial hub and a gateway to Asia, offering world-class wealth management services. Compared to jurisdictions like Hong Kong, which remain racked by uncertainty, due in part to increasing Chinese regulatory control, Singapore remains an appealing alternative. This appeal has only increased post-2022 as Russian wealth looks for new, non-Western havens. While Singapore has imposed its own limited sanctions against Russia, particularly concerning cryptocurrency trading, specific bank activities, and export restrictions, it has crafted a pragmatic middle ground approach. DBS's management has famously reiterated that the bank is compliant with its regulatory environment, with additional client-specific risk controls, including enhanced sanction screenings and source of wealth verifications for Russian clients. The focus, notably, is not a blanket target on Russian nationality or origin, but rather individual assessments. This gives DBS substantial competitive maneuverability, allowing it to serve sanctioned and non-sanctioned Russians in ways that minimize legal risk but still capture lucrative business partners. Given the $1 billion plus in client assets transferred to DBS by former Credit Suisse clients, the reward certainly seems worth the considerable degree of calculated risk. To understand why DBS, Singapore's biggest bank, seems willing to bear the regulatory uncertainty involved in serving Russian clients, we must appreciate the massive capital flight from Russia. For affluent Russians, particularly those not directly sanctioned or linked to the Kremlin, the move to transfer wealth to safer environments outside Russia is driven by 1. The fear of confiscation or regulatory overreach in Russia itself. 2. A desire to circumvent Western financial restrictions, especially access to global financial markets. 3. The attraction to neutral financial hubs like Singapore, which offer sophisticated banking services without the intense scrutiny faced in Europe or the US. This means banks like DBS find themselves at the intersection of an unprecedented wealth migration movement which, if handled deftly, provides rich business opportunities. Their ambition to double wealth management fees by 2027 isn't outlandish when catering to an increasingly geopolitically displaced but immensely wealthy clientele. Given the minimum $20 million deposit required for Russian clients at DBS, significantly higher than what other clients typically need, the payoff potential is extremely high. To put it bluntly, the market rewards the bold, and right now, DBS is playing an ambitious but calculated game. But this ambition does not come without risks. 1. Secondary sanctions risk exposure. As sanctions evolve, and penalties are broadened beyond primary actors, there are growing secondary sanctions risks for financial institutions that continue to deal with Russian wealth. The danger here for DBS, and broadly Singapore-based financial institutions, is not necessarily getting caught for any wrongdoing today, but being retroactively penalized by Western regulators if the rules evolve in a direction that DBS hasn't anticipated. 2. Reputational damage. Although DBS has primarily focused on legal risks with strict compliance programs, reputation damage is another major concern. Publicly, DBS must walk a tight line. How can they continue to support questionable and controversial customers without looking like they're openly profiteering off the geopolitical misery that ensues when sanctions fail? While the DBS decision evokes strong emotions concerning banking ethics, let's not lose sight of the broader impacts on Russia's economic fortunes and by extension, global recessionary risks. As sanctions increasingly wall off Russian access to Western capital markets, the country's overall economy finds itself further isolated. The Russian ruble has edged sharply downward, inflation has skyrocketed, and Moscow's fiscal budget, stretched by the costly and protracted invasion of Ukraine, is increasingly at risk. The long-standing flight of capital from Russia, compounded by brain drain and increasing sanctions, is already leading to stark forecasts. According to the World Bank, the collapse of foreign direct investments combined with diminished private sector confidence is plunging the Russian economy into structural inefficiency. But here's the conundrum. If institutions like DBS continue finding ways to serve Russian HNWIs, they're effectively propping up a financial system trying to undermine the same Western sanctions narratives. It's often said that economics doesn't operate in isolation, and here's a flashing red example. When sanctions are poorly coordinated across jurisdictions, they often fail to achieve the intended full strangulation of target economies, in this case, Russia. Instead, capital flows adapt, searching out new circuits where existing openings, however legally sound, allow sustained financial outflows from politically isolated regions. The implications of sanction busting, as seen through banking loopholes, mirror the broader failure of global coordination. The disparity in sanction policies between the US/EU versus Asia underscores the fissures in global governance frameworks, especially regarding aggressive diplomacy. This competition and lack of cohesive policies will contribute to further geopolitical volatility and prolonged economic conflicts globally. DBS's strategy undoubtedly positions it uniquely in both the Asian and global financial landscapes. They've taken bold moves, hiring Russian-speaking bankers and building relationships with Russian fortunes as others shy away, a strategy that's raising both eyebrows and questions across the financial and regulatory world. Competing amidst fractured global financial regulations, they find themselves straddling a fine line between legal opportunity and looming economic risks. But one truth remains, as we've seen through increasingly tighter sanctions, wealth always finds a way to move, even if that way is through small openings in otherwise well-guarded doors. Singapore, for now, and banks like DBS, are playing a pivotal role in this shifting financial landscape, but like all strategies in volatile markets, the sword cuts both ways. The question on everyone's mind is whether DBS can hold this balance without plunging itself and Singapore's banking sector deeper into a regulatory minefield. Until next time, keep your eyes on the numbers, and never forget, when governments fail to plan, economists are left to clean up the mess.